Hi everyone. This video is to help you calculate the value per share for publicly traded companies in the North American markets. I'm using the website Stockcalc.com to do this. You can access this site by simply typing Stockcalc.com. The welcome page will come up automatically. The purpose of this site is to screen, collaborate, and value public companies. I have an account set up, but you can access the site for a 14-day free trial by simply clicking the Try Stockcalc Now button. We're going to walk through 3 steps to calculate the value per share for Google, Alphabet, using the site. So I'm going to start by logging in. The site will take a few seconds to load to get prepared. What we're going to do is we're going to focus on the research section of the site. And we can access the research section in 2 ways: through this button or through the dashboard research. So you're looking at the dashboard here. We can access the research section directly by clicking on research. Research contains all of the tools in the site that allow us to do the calculations. So what we're going to do is we're going to do 3 different calculations so that we can calculate the value per share for Google. It's a 3-step process. The first step, we're actually going to go into the valuation and cost of capital menu. We're going to type GOOG for Alphabet, select it from the drop down, and as it loads, you'll see there are different tabs that are here: beta, cost of equity, cost of debt, cost of preferred, and weighted average cost of capital. The weighted average cost of capital is the blended cost to the company to raise capital either in the equity markets or debt markets. So that's why you see there's a cost of equity and a cost of debt. Beta is a calculation we do that feeds the cost of equity, and we'll show you that in a second. What beta is an expression of how we expect the stock to move compared to the underlying index. So if the NASDAQ moves up or down 1, we would expect Google to move up or down 0.85. We generally do this over a 60-month calculation period using the close price. So we have a beta calculation of 0.85 for Google in this case. The cost of equity is essentially what the market would expect to get for a return in the equity markets by investing in that company, if you think of it in that context. So with this beta, we can calculate the cost of equity 2 different ways. We can calculate the cost of equity using the CAPM method with the beta, or we can calculate it alternately with the build-up method by adding up the rate premiums that we have above. So in this case, we would expect a cost of equity of 8.66% for Google if we use the capital asset pricing model. Cost of debt is what it costs the company to service the debt that it has, basically the interest divided by the debt. And debt, in terms of the cost of debt, is an after-tax cost, so we actually reduce it by the tax rate. If the company has preferreds, we basically take the dividends divided by the total preferreds to come up with a cost of preferreds, and then we use the WACC to pull this all together. So in this case, Google is essentially all equity value with very little debt, 99% to the 1% debt, which means its cost, its weighted average cost, is essentially equivalent to its cost of equity. We're going to use the cost of equity from the capital asset pricing model. We get a calculation of 8.59, and we'll save that WACC. So all the WACC is the percentage of equity times the cost of equity plus the percent of debt times the cost of debt plus the percent of preferred times the cost of preferred. That gives us this blended cost. So that's the first step, is calculating the weighted average cost of capital. We've actually set up predefined cost of capital for the over 8,000 companies that are in the database. But if you're going through a valuation calculation, it's wise to walk through these steps to make sure that you do the weighted average cost of capital calculation so that you're comfortable with it. The next step is to forecast the financials. So larger companies like Google, we would have analyst coverage in the database. What you see here are previously saved forecasts, but I'm going to start with a new one. Type GOOG again into the text box and I'll generate a forecast from that. Here you have all of the analyst data that we have in the database for Google. Earnings per share estimates, revenue estimates, cash flow and EBITDA estimates, net income, debt outstanding, projected tax rates, capital expenditures, and growth rates. So this information is all very useful in calculating the valuation for the company. You also see the recommendations for the company, 11 buys, 3 holds, and a target price estimate of $831 in 2016. We use all of this information to generate a forecast for the company. So you can see the total revenue, 67, 79, and 94 are coming directly from the analyst data. 67, 79, 94. So we can accept all of this information as we have it, or we can edit, change whatever we want, and then save it. So for now we'll accept it. We'll save this. So we have forecasted data for Google. What I'll do is I'll rename this. I'll call it Google Demo. I'll save that. So there's 2 steps. I'm going to quickly look at this again. You'll see the CapEx 10, 12, and 12. We'll remember that. Tax rate 20%. So we'll remember that as well. We'll go into the valuation. And this time we'll look at the discounted cash flow. Again, you can see previously saved discounted cash flows, but we'll do a new one. So anytime we've saved a WACC and a forecast, we will have the company available in this drop down. So I'll select Google here. And all of the forecasts, in this case we have 2 of them. I'll select the Google Demo forecast that we did. And the system will load that. So we get an initial calculation with all of the data that we have of just under $600 for Google. You see that the stock is currently trading at about $775, and the analyst estimates were $831. So let's dig into this a little bit. So what a discounted cash flow does is it basically takes the cash flows that are projected into the future, removes the taxes, gives us a discretionary cash flow after we take into consideration what we think is required for capital investment or working capital needs. We discount all of this at our cost of capital, add them all together, remove any interest-bearing debt and any preferred stock that's in the company to give us the value of the common stock or common equity. We divide that excuse me, by the number of fully diluted outstanding shares to come up with a value per share calculation. So I'm going to look at a couple of things here. The growth rate here is approximately 15% year over year. And we have a terminal growth rate in here. What the terminal implies is the value beyond the last year that you have. So in this case it would be 2018 and beyond. So what I'm going to do is I'm going to adjust the terminal rate to 4 to see what kind of an impact that has. So that's taken our calculation from just under $600 to just over $700 per share. You can see quite a significant impact based on that terminal. The reason for that is that the terminal represents all of the value beyond 2017. So if we look down here, we can see the discounted terminal value is $445 billion of the approximately $500 billion in the total discounted cash flow that we have. $50 billion in the next 3 years, $445 thereafter. So a lot of the value of the company, the majority of the value of the company, is tied up in its terminal value. So the company is very sensitive to this terminal growth rate. The other thing that we can look at is the weighted average cost of capital. We calculated 8.59. As I said, we have a predefined for all of the companies. So if I use the predefined just to take a look at it, 8.05, we're up to $821 a share, which is much closer to the $831 a share that we saw that the analysts have. So you can see we can quickly play around with the numbers that we have here to take a look at the valuation of the company. There were a couple of things that we saw. For example, CapEx was 10, 12, and then 12 billion respectively. So we would assume 12 billion as well as a terminal value. That takes us again back down to the 596 valuation. So down below $600 again. So with those capital investment requirements, obviously our terminal growth rate has to be even higher to accommodate the current price. We would be looking at a terminal growth rate of 5% in order to reflect this. So that's a very strong terminal growth rate for a company to expect to grow at 5% forever. Generally, we expect 3 to 4% for most companies. So what the tool allows us to do is very quickly look at the impact of these different components to see how sensitive the company is to the growth rates, to the cost of capital, and so forth. Now, one thing you may look at and say, okay, I know that there's an analyst consensus of $831 a share, so why would I even bother doing this? Well, two reasons. One, we can start to understand what the expected growth rates, cost of capitals, tax rates, etc. are for the company and how they impact the valuation, and are you comfortable with that? And the second is for any companies that do not have any analyst coverage, and there are quite a few of them, you can use the tools that are here to generate your own weighted average cost of capital, generate your own forecast, for example using growth rates, what you expect the company to grow at, and then do the valuation calculations on the company. There are also a number of other valuation modules, tools that are available on the site, but for now we're focused on the discounted cash flow. So we hope you found this video useful and informative, and we hope you find the site useful. Please sign up for a 14-day free trial and test the companies that you're interested to determine their value per share. Thanks very much.